Hello friends, this is Denario Research and welcome to the fifth part of cryptocurrency trading tutorial. Today I'll continue the topic of candlestick chart analysis and will show you some basic candle patterns. Every candle pattern has some stages which must occur before you open position. First is trend. Candlestick patterns are valid only on a trend. So suppose we have an uptrend. Next go pattern itself. And the last, confirmation. Personally, I use two confirmation signals. First is volume. It has to be far above average value under the pattern. And the next is confirmation candle. So in case of uptrend, it has to be bearish confirmation candle that closes below the pattern. This is a signal to open short position. Of course, there is no 100% guarantee that price will go down, but probability is quite high. In case of downtrend here, you should observe bullish reversal pattern, confirmed by high volume and bullish candle, so long green candle that closes above the pattern, signals you to go long. But as in a previous case, you should manage risk carefully to exit trade in case of trend continuation. So there is always some extent of probability that price may go here, downwards instead of upwards or sideways. Some aggressive traders do not wait for confirmation candle, so they start to open position having pattern and volume only. But I am more conservative here. When all prerequisites match, so we have trend, we have pattern, and we have confirmation, whatever you like, there is high probability of a trend reversal or at least sideways. But never blindly pick every pattern and jump into position without having a trend and confirmation, like volume, or if you are conservative, reversal candle. Here are some other examples. We have an uptrend and continuation pattern. In case of uptrend, bullish, of course. Once it is confirmed, there is a high probability that price will surge further. And you can open long position, so if you miss to do it somewhere here, you may open here, or increase existing position. But always remember that there is some probability that market will go in opposite direction, so be careful and manage risk because price may go downwards as well. Downtrend is quite similar, so we have bearish continuation pattern, and once it is confirmed, so we know already confirmation signals like volume and bearish candle in our case, long bearish candle that closes below pattern. So price may go down and you may open a short position. Frequently you can observe various patterns on a sideways. So sideways is absence of uptrend or downtrend. Such patterns can lead to uptrend or sideways continuation or downtrend. But do not trade. Patterns work poorly on a sideways and future price movement is random and absolutely unpredictable. So, as I said before, do not blindly pick every pattern and jump into trade. Let's look at some examples on a chart. In this example, we observe clear uptrend and bearish reversal pattern on the top. It is confirmed by high volume. You see it's far above average below the pattern, and long bearish candle, which confirms trend reversal. Depending on your trade entry approaches, you may enter into trade somewhere here if you're conservative, or even below green candle, so somewhere here if you are too conservative. Or if you are aggressive trader, you may open short position somewhere here. In the next example, downtrend is followed by bullish reversal pattern, which is confirmed by high volume as well, and long bullish green candle, meaning you may open long positions somewhere here. Actually, high volume on a downtrend frequently signals its end. Just wait for pattern, volume, and confirmation. If you need, check news, and if most of the factors match, enter into trade. When you analyze patterns on a real price chart, you will see that they rarely have the same shape as in a textbook. And it's okay. Your goal is not to match patterns, but rather to understand the sentiment behind those patterns. Now you know main pattern stages, and it's time to analyze some of them. I will talk about few most popular candlestick patterns every trader must know. I will start with the candle mentioned in my previous video tutorial, doji. Doji are important candlesticks that provide information on their own and as a components of some other patterns. Doji form when open price and close price are equal, like in this example, here, 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 are almost equal, like in these two examples. The length of upper shadows and lower shadows may be different, resulting in some variations of doji. So upper is longer, lower is longer, shadows are equal, and long shadows are equal, but all these candles are dojis. So typically doji with equal open and close price are considered as more robust. So these two candles are less robust, at least considered less robust than the rest of them. But what is the sentiment behind the doji? Price moves above its opening value, below its opening value, and closes at the same level like here, or almost the same level like here. Anyway, result is standoff. Neither bulls nor bears were able to gain control, and reversal point could be developing here. What does it mean on a trend? In case of uptrend, doji, preceded by long green bullish candle, signals that buying pressure is starting to weaken. On a downtrend, doji, after a long red bearish candle, signals that selling pressure is starting to diminish. Doji indicate that forces of supply and demand are becoming more evenly matched, and a change in the trend may be near. Of course, doji alone are not enough to mark reversal, and confirmation is needed. On an uptrend, after long green bullish candle, doji may signal that buying pressure may be diminishing, and an uptrend could be nearing an end. Whereas a price can decline simply from lack of buyers, and continued buying pressure is required to sustain an uptrend. Therefore, a doji may be more significant after an uptrend. Even after doji forms, further downside is required for bearish confirmation. So this may be a gap between doji close here and next candle open here, so it's significant gap. Or as we already know, it may be long red bearish candle. After a long green bullish candle and doji, traders should be on an alert for potential evening doji star configuration. After a decline and long red candlestick, doji can indicate that selling pressure may be diminishing and the downtrend could be nearing its end. Even though bears are starting to lose control of the decline, further strength is required to confirm any reversal. Bullish confirmation can come from a gap between doji close and next candle open. Of course, it has to open above the doji close, or long green bullish candle. After long red candlestick and doji, traders should be alerted for a potential morning doji star configuration. Morning and evening doji stars are the simplest and quite frequent candlestick patterns. But before jump into trade, you must identify trend and sufficient volume. In the next video, I will continue topic of candlestick patterns and will show you more complex configurations. This is all for today. Thanks for watching. Thumbs up if you like this video, subscribe to my channel if you want more videos, and leave your questions in the comments section below. Bye.